Welcome to our deep dive into non-deliverable forwards, or NDFs. These financial contracts play a crucial role in global markets, especially where currencies are restricted or non-convertible. NDFs allow two parties to agree on a future exchange rate without the physical delivery of the currency. This mechanism is particularly valuable for businesses and investors seeking to hedge against currency fluctuations in emerging markets. Understanding NDFs is essential for anyone navigating the complexities of international finance, as they offer a practical solution for managing currency risks and ensuring stability in volatile environments. Non-deliverable forward is a financial contract used in foreign exchange markets to hedge or speculate on currency movements in restricted or non-convertible currency markets. Unlike traditional forward contracts, NDFs settle in cash based on the difference between the agreed forward rate and the prevailing spot rate at maturity. Popular for currencies like the Indian rupee, Chinese yuan, and Brazilian real, NDFs are traded over the counter, offering flexibility in terms and conditions. They are widely used by multinational corporations, financial institutions, and investors to manage exchange rate risks without the need for physical currency delivery. NDFs operate on a straightforward mechanism. Two parties agree on a notional amount, a forward exchange rate, and a settlement date. Unlike traditional contracts, there is no physical delivery of currency. Settlement is performed in cash, typically in a freely convertible currency like USD. On the settlement date, the difference between the agreed forward rate and the spot rate is calculated. If the spot rate is higher, the seller pays the buyer. If lower, the buyer compensates the seller. This cash settlement ensures that the actual currency is never delivered, making NDFs ideal for markets with currency restrictions. NDF contracts have several distinct features that make them attractive for hedging and speculation. They are non-deliverable, meaning no physical currency is exchanged. Settlement is in cash, calculated based on the notional amount and the rate difference. NDFs are mainly used for currencies in restricted markets such as INR, CNY, and BRL. Their over-the-counter nature allows customization of contract terms. NDFs are valuable for risk management, especially in emerging markets, and do not require currency convertibility, making them practical for global finance. NDF market attracts a diverse range of participants. Institutional investors like pension funds and mutual funds use NDFs to hedge currency risks. Hedge funds often speculate on currency movements in restricted markets. Multinational corporations rely on NDFs to ensure stable cash flows and profitability. Central banks participate to manage currency volatility and maintain economic stability. Exporters and importers use NDFs to lock in exchange rates, protecting themselves from adverse currency movements. This diversity highlights the significance of NDFs in managing currency risks and facilitating global trade. While NDFs offer several advantages, they also come with inherent risks. Exchange rate volatility can lead to significant financial losses. Counterparty risk arises since NDFs are OTC contracts, meaning one party may default. Liquidity risk is present, especially for less commonly traded currencies, making it challenging to enter or exit positions. Regulatory challenges vary across countries and can impact accessibility and usage. To mitigate these risks, traders employ strategies like diversification, setting stop-loss limits, and conducting thorough due diligence before entering NDF contracts. NDFs are particularly useful in markets where currency convertibility is limited or restricted. For example, currencies like the Indian rupee, Chinese yuan, and Brazilian real are subject to capital controls. NDFs allow participants to hedge or speculate on these currencies without the need for physical delivery. This makes them a practical tool for multinational corporations and investors operating in emerging markets, providing a way to manage currency risks and navigate regulatory environments effectively. April 2026, the Reserve Bank of India (RBI) took a significant step by prohibiting banks from offering rupee NDF contracts to corporates. This move was prompted by increased FX volatility and aimed to discourage speculative trading, support the rupee, and regulate the FX derivatives market. The directive, although temporary, had immediate implications for banks, corporates, and other aspects of foreign exchange dealing. It marked a shift in India's regulatory approach, emphasizing transparency and discipline in the FX market. RBI's ban on rupee NDFs was driven by several key objectives. First, it aimed to curb speculative arbitrage, preventing traders from exploiting differences between onshore and offshore markets. Second, it strengthened monetary control by restricting derivatives based on offshore prices. Third, it promoted genuine hedging, allowing deliverable derivatives for hedging purposes only. Finally, it closed regulatory loopholes that companies were using to their advantage. These measures were designed to stabilize the currency and ensure a disciplined market environment. RBI's measures had an immediate impact on the market. The rupee strengthened as speculative pressures decreased, and market players unwound their arbitrage positions, stabilizing the currency. The spread between onshore and offshore rates widened, making offshore transactions more costly for traders. Banks faced difficulties unwinding arbitrage positions due to mark-to-market losses, while corporates lost some liberty in the NDF market. These effects highlighted the RBI's ability to influence market dynamics and maintain currency stability. RBI's actions were part of a broader regulatory tightening. A $100 million cap was placed on banks' net open positions in the rupee, severely restricting their capacity to take directional positions. Rebooking canceled derivative contracts was prohibited, preventing continuous trading based on short-term fluctuations. Restrictions on FX derivative transactions with related parties aimed to prevent arbitrage through intragroup entities. These measures collectively reduced exposure to volatility and closed loopholes in the regulatory framework. April 2026, the RBI partially lifted the restriction, allowing banks to issue NDFs and rebalance their exposure. However, this did not signal a return to previous practices. Banks maintained high prudence due to uncertainties about regulatory parameters and risks of further restrictions. The phased approach reflected the RBI's intent to remain flexible and responsive to market dynamics, ensuring stability while adapting to new threats and risks. Market participants now pay special attention to compliance and regulatory developments. RBI steps have broader implications for India's FX market. There is a shift towards onshore markets for hedging and price information, reducing reliance on overseas NDF markets. The regulatory framework is now more efficient, with the RBI prepared to take quick actions for financial stability. Corporate treasuries must reassess their hedging strategies, focusing on actual exposures. While liquidity may be limited, these measures build confidence among global investors, signaling a disciplined and stable regulatory environment. RBI's intervention achieved its goal of stabilizing the currency and curbing speculation. However, it also reduced access to hedging tools, potentially increasing costs for corporations with genuine hedging needs. There is concern that administrative measures rather than market-based solutions might impact the development of India's derivatives market in the future. Balancing regulatory efficiency and market freedom remains a challenge, as the RBI continues to adapt its approach to ensure both stability and growth. Non-deliverable forward contracts remain essential for managing currency risks in restricted markets. The RBI's recent actions highlight the importance of regulatory intervention in maintaining stability and discipline in the FX market. While NDFs offer flexibility and practical solutions for hedging, participants must stay aware of associated risks and regulatory changes. The evolving landscape requires careful strategy and compliance, ensuring that businesses, investors, and financial institutions can navigate global markets effectively while supporting the broader goals of financial stability and growth.